Welcome to this week's edition of Market Outlook. I am your host, Derek Taylor, also known as DT. Market Outlook is a weekly podcast where I take a look at last week in the market as well as previewing the week ahead in the market. I also will share with you some potential options trades that I think are interesting for this week. So this week's major stock market stories included renewed concerns over the Federal Reserve's interest rates cuts, a sharp sell-off in tech stocks, as well as mixed corporate earnings reports, notably earnings reports from Cisco and Disney. The market is also reacting to fading hopes for a December rate cut. A tech sector rotation is also hitting the big tech names. You're seeing a lot of pressure, especially on the chip stocks, the AI stocks, and the quantum computing stocks. And you're seeing pressure on certain companies like Tesla due to weakening sales and competition. So this past week, we saw some serious weakness in the market. Really, the past 2 weeks, we've seen some serious weakness in the market. And a lot of that is really because of the Fed rates, right? It's because of the interest rate outlook. Things have changed a little bit. Right now, hopes for a Federal Reserve interest rate cut in December have dropped. They've dropped significantly. Traders now are pricing in less than a 50% chance of that December cut, and this has increased some market pressure. Also, there's been a big tech sector rotation. A lot of people are getting out of some of the high-flying, risky tech stocks, and they're getting into less risky assets. So you've seen a major sell-off in technology stocks. You've seen the S&P 500's tech stocks falling. You've seen market breadth narrowing. Also, some of the chip stocks like Micron, AMD, Nvidia, they showed some recovery toward the end of the week, but overall, they are well off their highs. Earnings from last week were a mixed bag. We saw companies like Disney beat profit expectations, but their revenue missed estimates, and that led to a pretty significant share price drop. We saw Cisco report strong earnings, and they raised their guidance, which was actually a positive outlier for Cisco and that sector. Probably the biggest story, really for the last month or so, has been the sharp decline in crypto. The price of Bitcoin hit a 6-month low this past week, dragging down related companies like Coinbase and Robinhood and other stocks that are very heavily invested in crypto. Some other notable events: the government shutdown ended this week, and that was, you would think that would have been a positive for the market. Oddly enough, when the government was shut down, the market stayed kind of strong through most of that 40-day period. But there toward the end, when it became apparent that the government shutdown was about to end, that's when we saw a little bit of the market selling off. Was that a buy the rumor, sell the news kind of event? Who knows? Also, Tesla shares fell as reports indicated that there was a steep decline in China sales, highlighting some intense competition in the Chinese auto market. Also, we saw VIX increase significantly for the second week in a row. So VIX, obviously, that's the volatility index of the S&P 500 index, and it jumped up more than 6% this week, and that was after a jump of nearly 6% the week before. So volatility is really being pumped into this market right now. So let's take a quick look at what the market indices did this week. Taking a quick look at the SPX for those watching the video portion of the podcast, you can see Monday this week, we started the week with a big gap up because over the weekend, last weekend, we knew that there were talks about ending the government shutdown, and that was a positive day for the market. So we saw a huge gap up from the previous Friday to the following Monday. So we started the week like gangbusters, and then that upward pressure continued on Tuesday, and then on Wednesday, we saw a little bit of an up move early in the day, and then it sold off hard. And then that selling continued on Thursday with a huge down day leading into Friday, a significant down move Friday morning, but we eventually rallied on Friday all the way back to essentially being unchanged on the day on Friday. Now, what does that kind of 5-day pattern signal? Well, it signals there's a ton of volatility in this market, right? These moves on these candles are rather insane, especially the moves on Thursday and Friday, extremely volatile days in the market. Overall, though, how did the S&P 500 do on the week? Well, the SPX finished the week down 0.8%. So it finished the week down just under 1%. But remember, the S&P 500 was down a little more than 2% the previous week. And if you're looking at the chart here for the last, say, 2.5, 3 weeks, this chart looks kind of ugly, right? This is not what you would expect for what has been a pretty bullish market. Now, if we take a look at the NASDAQ, let's switch over to a chart of the NDX, the NASDAQ index. The NASDAQ was quite a bit weaker than the SPX. So the NASDAQ finished the week down 1.6% on the week, and very similar. Had positive days on Monday and Tuesday, and then Wednesday, Thursday, Friday, you saw a little bit of a waterfall effect where the market really sold off, and that accelerated all the way into early Friday, and then you got a little bit of a relief rally late on Friday. So this week could have been uglier had we not got a pretty serious rally late into Friday. But overall, NASDAQ was down 1.6% this week. And again, NASDAQ had an ugly week the week before. It was down 4% the week before. So we're, I don't know if we're in that raging bull market that we've gotten used to all year. I mean, for the last, say, 7 months, 8 months, it's just been straight to the moon. But really the last 2 or 3 weeks really in the market, things are starting to change, and they have me a little worried. Taking a look at the RUT, RUT, which is the Russell 2000 index, this finished the week down 2.6%. Ugly, ugly, ugly week in the Russell 2000, and this was after a week where it was down 2% the week before. If we take a look at the Dow Jones, so let's take a look at DJX, the Dow Jones Index, we can see that that finished the week down. Well, if you're actually looking at the chart, it finished the week about where it started, almost exactly where it started. It actually finished the week slightly up about 0.1% or so. Now, why is the Dow Jones essentially unchanged while the S&P, the NASDAQ, and the Russell were all significantly lower? Well, remember, the Dow Jones is only 30 stocks, where the S&P 500, of course, is 500 stocks. The NASDAQ is 100 stocks. The Russell's 2,000 stocks. They're much more indicative of the broader market than the Dow Jones. The Dow Jones only being 30 stocks, all you need is 1 or 2 stocks in this index to have a pretty good week, and it kind of cancels out everything else. So for me, I don't pay attention too much to DJX in my trading. As far as the Dow, it's not something I ever trade, and it's not something I really treat as a good indicator of what the market is doing. We've already talked about some of the increases in VIX, but VIX finished the week up 6.5%. So if you look at the 5-day candles here, we saw a gap down in VIX on Monday when the market was up big. But then Wednesday, Thursday, Friday, as the market is selling off, of course, volatility is increasing in a big way. And I mentioned the previous week, we saw a lot of increase in volatility as well. And again, this has me a little spooked. These last couple of weeks have made me lighten up a little bit on my positions because the market is uncertain where it wants to go right now, and because of that, I'm kind of uncertain where the market is going to go. So anything that I deemed as a little bit too risky, I lightened up a little bit. I was using about 50% of my buying power for trading earlier this week, and I lightened that up all the way down to about 35% of my buying power is in use now. Why? Is because I want some buying power on the side if this market goes lower, because if this market goes lower, I'm going to want to scoop up some deals. And if I'm already using a lot of my buying power, I'm not going to have money available. So with VIX, signaling that the market is worried, with the SPX and the NDX signaling that the market is worried, I lightened up a little bit. That way, if we do get another good down move, I will be prepared to scoop up some of those deals. So let's talk about the market sector. So what sectors were strong last week? What sectors were weak? Well, let's start with the sectors that were weak because the market had a big down week. We know the tech sector leads the market. It leads the market up. It tends to lead the market down as well. So if we start with XLK, which is the tech sector ETF, this was ugly. It's down about 1.8% on the week. So XLK, really an ugly chart, but it actually was not the worst sector for the week. As weak as tech was, XLY, which was consumer discretionary, was even weaker. Now, consumer discretionary, because it's discretionary, right? This is the stuff you would expect to do well when the market is doing well. So you expect staples to do well when the market is doing bad, because that's the stuff people actually have to have, consumer staples. Consumer discretionary is the extra money people spend when things are good. And right now the market's kind of weak. So XLY consumer discretionary is very weak, down 3.1%. Another sector that had a bad week, XHB, the home builders, this was down 2.4% on the week. And a couple of other sectors I do want to mention. XLU, the utilities sector, finished the week down a little more than 1%, about 1.3% on the week. XLI, the industrial sector, finished the week also down about 1.3%. Now, with the broader market selling off, you wouldn't expect too many sectors to have a great week, but one did. XLV, the healthcare sector, finished the week up 4.1%. You can see, looking at the chart, Monday, Tuesday, Wednesday, Thursday were all green days, and significant green days. And then it sold off a little bit on Friday, which was strange because the market was having a rally on Friday a little bit, especially late in the day, where the healthcare sector really didn't do too much that day. On a very similar note, XBI, biotech, similar to healthcare, right? But biotech has had a monster move over the last few months. It's been maybe the strongest sector here recently, and last week it had another great week. XBI finished the week up 3.4%. The energy sector, crude and natty gas were moving around a lot last week, but the energy sector, so that's your energy stocks, 2.5% up on the week. And then we mentioned consumer staples. Consumer staples, unlike consumer discretionary, tends to do well when the market's doing bad. So consumer staples was actually up 1% on the week. Let's take a look at some of the commodities and the futures products. Since we were talking about XLE, the energy sector being up 2.5%, let's take a look at what oil and gas were doing last week. So a chart of USO, if we take a look at the 5 days of last week, you can see USO finished the week slightly down about 0.3%. So it was actually a bit of a down week for oil, but just a very small down week. But UNG, which is the natural gas ETF, it mirrors the natural gas futures. UNG finished the week up about 5%. We had a monster move in natural gas last week. We also had a monster move in natural gas the week before, and really the week before that. So natty gas has been on a tear if you've been playing it as a bullish play. One of the things that I think is hurting the stock market is the crypto markets. So crypto has been very weak. So ETHA, which is the Ethereum ETF, so it tracks spot Ethereum prices, ETHA was down 13% on the week. Just a monster down week. And that was after a pretty ugly week the week before, and a pretty ugly week the week before, and really the last 2 months looking like death, right? Ethereum, it's had a high about a month ago of $36 a share, and that's ETHA, and now it's trading at 23 and change. So that is like a 35%, just ballparking it, 35% reduction in price, way off its recent highs. If we take a look at IBIT, which is the Bitcoin ETF, this tracks spot Bitcoin prices. You can see IBIT had a just monster down week, down over 11%, so very similar to Ethereum, and very similar, had a bad week the week before. It's had a bad 2 months. IBIT was trading just under $72 a share about a month ago, and now it's trading at 53 and change. And I think a lot of people saw the weakness in the last couple of months as a buying opportunity. A lot of people have been scooping up some Ethereum and some Bitcoin, and I was one of those people. I was putting on some options trades, some bullish options trades in IBIT and ETHA. I got out of my IBIT position last week. I'm not certain that this down move is over yet. This is another one that's kind of scary to me. Like, I want to see some sign that this move is over. This move has gone on a little too long, and especially the move on Friday. Both IBIT and ETHA had a big drop on Friday. I'm just not certain that the down move is over. So I'm staying out of it, at least playing it as a bullish trade. I'm staying out of it right now. I want to see at least something change on these stock charts before I start scooping up shares of IBIT or ETHA. Let's take a look at how the US dollar did last week. So if we take a look at UUP, which is the dollar index ETF. Really, the dollar was kind of weak last week. It actually finished the week down about 0.2% or so, so slightly weak. Really nothing to write home about. If we take a look at the 6E futures, you can see that the 5-day chart of 6E, the euro, finished the week higher. You would expect the euro to be higher with the dollar weaker because that's the relationship. The biggest component of the dollar index is the euro. The second biggest component is the British pound. So if we take a look at 6B, the 5-day chart of it, the British pound futures finished the week very slightly up, and then 6J is the third biggest component of the dollar index, and the Japanese yen was actually pretty weak this past week. It actually had pretty much 3 straight down days, followed by Thursday and Friday. It really didn't go anywhere after that, but that's only like a 17 or 18% of the dollar index is the Japanese yen. More than half of the index is actually the euro. Now, how did bonds do this past week? Well, bonds were really interesting because there's a lot of volatility in this. If you look at the 5 candles for the week, you can see Monday, not much happened. Then a huge gap up on Tuesday and good two-sided action after the big gap up. And then we pushed higher on Wednesday, and we're taking a look at TLT, which is the 20-plus year Treasury ETF, and then some real weakness on Thursday and Friday. So overall, though, for the week, we finished the week down about 0.7% in TLT. And looking at the chart for the last month, there's some weakness in the bonds, and that has the market spooked a little bit because the market wants bonds to go higher. Bonds trade higher, the more likely that the Fed might give us that rate cut in December. So we want bonds to go up. That's what the market wants. And, you know, with the bond market kind of dropping off the way it's been doing, that is hurting the overall stock market. And in fact, I would say if you're looking for things that are not necessarily stocks that are indicative of why the market is weak, all you need to do is look at what bonds are doing and also look at what crypto is doing, because so many stocks are affected by crypto prices. That is really been the biggest story for the last month or so. You could also take a look at the metals. Now, the metals didn't do too much. If you're taking a look at precious metals, gold was essentially unchanged for the last 5 days this week. We had a big gap up on Monday, and then we went literally nowhere after that. I mean, we had some good two-sided action, but it finished the week exactly where it started. If we take a look at silver, silver finished the week up about 1.5% or so. So pretty good week in silver. Some really big moves, really big ranges. So a lot of volatility is pumped in right now to both gold and silver. So if you want to trade options on these, especially if you want to sell options on these, there's plenty of volatility in things like GLD and SLV right now. Now let's take a look at some of the individual stocks that had a rough week. So because crypto is down, you know Coinbase had a bad week, right? So if you take a look at the 5 candles for Coinbase, this was a nasty week. Coinbase finished the week down about 12%. And let's take a look at Hood. Hood is, of course, Robinhood. It's a broker. They have a lot of ties to crypto as well, and they had a really nasty week. Their chart looks very, very similar to Coinbase. Another very similar stock chart. Tesla's not really tied to crypto, but Tesla had a rough week because of declining sales in China and just, news related events. Tesla finished the week down about 8%. Palantir is a rough one because I have a position in Palantir and it has been giving me fits because I got a strangle, and it's been killing me both ways because as it moves down, I roll my calls down and then it shoots right back up. And it starts punishing the call. So I've got to roll the puts up. And I've been getting whipsawed on a strangle in Palantir, and I'm down several hundreds of dollars now on this strangle. And a lot of volatility is being pumped in. Right now, the IV rank is only 19, but that doesn't really tell the story. The IVX right now is 62% in Palantir. It's got a lot of volatility, which is great if you're putting on a new position today. For me, already having an existing position for a few weeks, this has not been positive for my P&L on my Palantir position. But Palantir for the last 5-day week, you can see it finished the week down about 6%. Pretty ugly week. Amazon, one of the big mega cap tech stocks, probably had the worst week of the bunch, down about 5.5%. And Google had a pretty nasty week as well. Had a pretty good Monday and Tuesday, but later in the week sold off hard. Google finished the week down nearly 4%. And as always, I've got to mention the quantum stocks because I have my covered strangles in IonQ and Rigetti. So if I look at IonQ, it had, this week was not great in IonQ. It actually finished the week down 20%, right? So I'm bag holding. I've got 150 shares. I also have one contract of a strangle. And yeah, this has just been the death trade, right? This is not a trade. This is not a trade you would want to be in. But for me, I'm still long-term bullish in quantum stocks. Even though I'm holding the shares right now, I'm stuck in this position. I don't mind being in this position potentially for a few months if I have to, to wait on a recovery of the share price, because I do think these things will go back up. Right now, when the market is selling off anything that's kind of a speculative play, which quantum stocks are the most speculative play right now because these companies don't have any real earnings to speak of, right? So they're the first things people sell. They will be the first things people start putting back on, though, when people want to start taking a lot more risk. So these will probably come back, but Rigetti and IonQ right now had rough weeks. IonQ was down 20% on the week. Rigetti had an even worse week. It was down 25% on the week. Now, we did have some buckers, some stocks that actually finished the week positive. As far as the big tech stocks, AMD actually finished the week up. It finished the week up about 2%. Apple also finished the week up. Apple, over that 5-day period, finished up about 1.3%. And finally, Netflix. Netflix, on Monday, Netflix will be priced at the new post-split price. So they're doing the 10-to-1 split. So finish the week trading around $1,100. It'll be trading at $110 a share first thing Monday. Splits are typically good news for companies. That's a sign that they're growing. And then more people will jump in now that it's a much more affordable share price. So don't be surprised if Netflix doesn't get a little bit of a bump this week as more people that couldn't trade it before start trading them. So this past week, Netflix finished the week up just slightly. It finished the week up about 0.5%. But let's talk about some earnings for this week. We really don't have much going on. We're at the end of the earnings season. The big earnings event this week will be NVIDIA. It's the last of the big mega cap tech stocks to report. But outside of that, it's going to be slow going for earnings. On Monday, there's really nothing worth speaking of, nothing worth playing as an options trader. Now, Tuesday, we have some interesting companies. We have Home Depot will report before the bell on Tuesday. So you have to play these on Monday. Home Depot reports before the bell on Tuesday. Baidu also reports, and PDD. So Baidu, PDD, they're both the Chinese tech companies. If you want to play those will have to be traded on Monday for Tuesday morning. Now, Tuesday after the bell, again, kind of like Monday after the bell, nothing worth talking about. But Wednesday before the bell, you've got some retailers. Target, TGT. I like trading Target. Usually it has pretty good implied volatility, so I'll probably play this one. Also, Lowe's reports, LOW. That's Lowe's Companies. And then also before the bell on Wednesday, another retailer, TJX, which is the company that owns TJ Maxx, Marshalls, Home Goods. All of those report before the bell on Monday, so you'll have to put those trades on Tuesday to play them for Wednesday morning. And then Wednesday after the bell is the monster one, right? That's NVIDIA. So that's the one everybody is waiting on, the biggest company in the world, well, depending on where it's trading at. And as far as market cap, it's a $5 trillion company, or they're somewhere close to that. It may have given back that $5 trillion market cap last week. But it's just a monster company. You can actually see, if I look in the TASTYTRADE platform, its market cap right now, 4.6. It's not quite 5 trillion right now. Also, Wednesday after the bell, reporting alongside NVIDIA will be Palo Alto Networks. That's ticker symbol PANW. Thursday before the bell, the mother of all retailers, Walmart, WMT reports. And then Thursday after the bell, we have Bull, which is Webull, the broker. Now, this is a rather new stock. It just IPO'd a few months back, so it doesn't have a lot of history. Probably not that interesting as far as options trades. And right now it's trading at under $9 a share. So there's not much you could do with that particular ticker. So let's discuss some trade ideas for the week. Let's start with the big earnings trades. Let's start with Target, because I did mention I like trading Target. Target right now has an IV rank of 61. So pretty high IV. You can see for the last year, it has steadily declined, but it's settled into a little bit of a range here in the last couple of months. So this might be one I do a strangle, because it's got really good IV rank. It's also got really good IVX. You can see 45% in the January cycle. If you want to trade the December cycle, it's got 52% IVX. So this screams strangle to me, because you want to make some money off of all that volatility. So you want to sell both sides of the trade, right? You get double that premium, that volatility. So I would sell the 14 delta put and maybe the 10 delta call. I'll give myself a little room to be wrong on the call side, because target has been weak. The stock chart looks kind of ugly. It's a little oversold in my opinion. So I give myself a little more runway to the upside. So a 14 delta put, a 10 delta call, that's the 75 put, the 115 call, and I get a credit of around $2. Looks like I get a credit of $2.04. Of course, this pricing will change. Target won't report until Wednesday morning, so I won't put this on and probably until Tuesday afternoon. But a $2 credit on a buying power reduction of $900, that's a really juicy risk versus reward to me. Now, of course, if you're going to play Target, you might as well play Walmart the following day, right? But, well, Walmart is not nearly as fun to play because Walmart is a low IV stock compared to Target. Walmart, you can see, has an IV rank of 38, but its IVX is only 29%. So if I wanted to play Walmart, I don't love selling strangles on things with low IV, but because you just don't get much for it. In this case, if I do the 13 delta put and the 9 delta call, 129 credit on a buying power reduction of $1,000, it's not a horrible trade. I certainly could take that trade, but because of the low premiums, this might be one I'd rather do a debit trade. For those, here's a great idea, and I'm not going to do this probably, but for those of you that want shares of Walmart, because Walmart long term, I think is a good company to hold shares. Walmart is pivoting, they're getting a little bit more into tech, other than just being a retailer with stores, a traditional retailer, they're getting into online retailing. They're eventually going to be heavy into AI. Like Walmart is really trying to change their company in a big way. And, they've always been a leader, so you get an IRA account and you want shares anyway. I love the idea of doing a covered call on this thing. Maybe go to the 34-day cycle. So go to the December cycle, go ahead and hit the ask here in TASTYTRADE. And you get 100 shares, right? And then also add maybe the 23 delta call. So this is your traditional covered call. Now, it's going to cost you about $5,000 in buying power because you've got to buy those shares, right? And the shares are going to cost you about $10,000, but you get a 50% discount on shares. Most brokers give you 50% margin relief on shares. So you only have to put up $5,000 for that. And then you get a little bit of premium for selling the call. You get about $1.15, $1.20 for selling the call. And so this is a win-win if you want the shares, because if the stock goes down, well, you wanted the shares anyway, but you get to keep the call premium. If the stock goes up, well, your profit. What is your profit? Well, max profit is $873 on the trade. So you're risking $5,000 essentially for $873. Well, that's not really your risk, but your buying power, you're tying up $5,000 for a potential profit of about $900 on the trade. One of the big tech stocks that I'm interested in playing now that it's sold off a little bit is Google. Google still has an IV rank of 25. It has an IVX of 34% in the January cycle. And because of that, I want to play this. Now, I think because of the recent sell-off, especially the big sell-off late last week, this might be a good time to put on a bullish trade, but at the same time, I don't know where the market is going. And when I'm uncertain, I don't want to just go sell a put. I think that's dangerous. What I want to do is do a put ratio spread. So I'm going to buy the 250 put. I'm going to sell the 245 put. So this is a $5 wide put debit spread. I'm going to pay 95 cents for it. If I pay 95 cents for this put debit spread, what is the max profit on the put debit spread? Well, it's 405, right? Because it's a $5 wide spread that I paid 95 cents for it. So if I win, I get 405. So that's how spreads work. You just take the width minus your debit or credit, and then you get your risk or your profit on the trade. So 95 cents is what I'm going to pay for that, but I'm going to double up this short put that has a premium of about $4 on it. So I'll sell 2 of the 45s. And now overall, I get a credit of $322 on the trade on a buying power reduction of $2,500. And this decent risk reward. It's not outstanding, but it's not horrible either. And I've protected myself a little bit on the trade. I want to be bullish, but if I'm wrong, having that embedded debit spread that's part of the ratio spread gives me an extra $4 of runway to the downside should something go horribly against me on this. And the other thing with a stock like Google, if things go horribly against me on the trade, I don't mind taking shares of a stock like Google. Google's not going anywhere, right? So if I want to run the wheel on this, I have one naked short put that I would take assignment of, and then I would win actually on the put debit spread portion of the ratio spread. So this would be a great way to start the wheel, or potentially start the wheel should the trade go against you, if that's what you want to do. And then the final trade I want to discuss, just because of the move that the metals have made, let's take a look at the GLD chart. So gold has a ton of volatility pumped into it. We saw the big run up and then the big sell off, and then a little bit of big two-sided action up and down in the past week. So a lot of volatility. IV rank of 58, IVX of 22%. That's not bad for gold. Remember, gold, it's not tech, right? But this just screams go put on an iron condor to me. So what I want to do is let's go sell the 350 put and then buy the 345. So we'll go $5 wide. I get 87 cents credit. That's a little more credit than I want on that side. Typically if I'm going $5 wide, I'd like somewhere between 60 and 80. So 87 cents was a little too much. So I'll roll this down. Let's go to 347 and 342 for the put credit spread. Yeah, now I receive 73 cents credit. Now let me go get about 70 cents credit on the other side. So let's go to the calls and let's go somewhere around the 18 delta. And let's go $5 wide. And do I get another 70 cents? Well, I get another 60 cents. So maybe the call side, we're going to have to lean in a little bit. So a little bit of call skew right now. And because of that, the call spreads trade a little cheaper. So I'll roll this down a little bit until I get a credit of 140. This is about what I want. I want to risk 360 to make 140, and that is your traditional iron condor. I have a pop on the trade of 61%, but I manage my trades at 50%. Always, and the P50 number is 78%. So about 80% of the time, I'm going to make my 50% profit, and it'll be a winner. And if it's not a winner, what about the 20% you lose? Are you going to lose 360 on the 20% you lose? No, the 20% is the losing number on the trade, but that doesn't mean you max lose on the 20%. You could actually finish with a lesser loss on the trade, or what typically, if you manage the way I do, I manage at 50% or at 21 DTE, whichever comes first. So if I put on the trade at 60 DTE and I get to 21 DTE and I haven't made 50% winner, I take the trade off at whatever the win or the loss is. And when you manage early, you never take the max loss. You almost never come close to the max loss on these trades as long as you manage early. So that's the smart way to always do your short options trades. Manage at 50%. Always, and also take them off early, well before expiration, because that prevents you from ever taking that gigantic loss. So that's it for this week's edition of Market Outlook. Now, for those of you that haven't already checked out my book, please check out my book, The Super Wheel Option Strategy, available on Amazon. This book is about my favorite option strategy, which is the wheel option strategy. For those watching on YouTube, you'll find a link to the book in the description below. For those of you listening to the audio podcast on Apple or on Spotify, please give Market Outlook a 5-star rating. I'd really appreciate it. Help us grow as a podcast, help us grow in the algorithm, because we have to fight the algorithm a little bit, right? We have to differentiate ourselves a little bit. We have to stand out, and you guys giving us those 5-star ratings definitely helps. One final thing I want to mention is my YouTube channel, DT Options. So I have a YouTube channel where I focus on educating people about options trading. It's called DT Options, and we've seen some real growth on that channel here in the last couple of weeks. I've seen a lot of new subscribers. I've seen a little bit of a bump in viewership, and I really appreciate, especially those of you that are new subscribers and new viewers. I hope you guys stick around, and I really appreciate the engagement I get on the channel. So please go check out DT Options on YouTube. All right, guys. Peace.